Do you want to know if Amazon stock is undervalued? And you want to know more about stock valuation with PE, PB, and PEG ratios? Then stick till the end of today's show. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you doing today? I'm doing fantastic if you were to ask me, and I hope you are doing marvelous also. And if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about whether or not Amazon stock is undervalued, and we want to have a deeper conversation around stock valuation with the price per earnings ratio, the price per book ratio, and the price to book ratio, and the PEG ratios, as well as there's the fourth valuation element that I want to talk about. That's the dividend yield. And I want to talk to you about how you can use those metrics to find out whether or not a stock in your portfolio is undervalued or overvalued. So let's first talk about the price to book ratio, the PB ratio. It's very important to mention that, folks, financial ratios are powerful tools to help summarize financial statements and the health of a company or enterprise. So you don't have to sit around and just go through the balance sheet of the company trying to look for all the assets, the liabilities, the equity, or go through the statement of income, or just take a look at the cash flow statements. And the great thing about financial ratios is that you're able to compare and contrast several companies regardless of the size. This is the great thing about it. In the financial analysis, there's something called common size financial statements, and that's even better in terms of understanding the valuation of a stock. So let's talk about the price to book ratio, the PB ratio. So companies use the price to book ratio to compare a firm's market capitalization to its book value. So just to give you a quick reminder here, when we're talking about market capitalization, we are talking about three categories. So you have the large caps. Those are companies whose market capitalization are above 10 billion. And then you have the mid cap. The capitalization here is between 2 billion and 10 billion. And then you have the small cap, whose capitalization is between 300 million and 2 billion. So the market cap is calculating. It's actually so the PB ratio helps you compare a firm's market capitalization to its book value. So you calculate PB ratio by dividing, and we're putting actually the formula on the screen right now. So it's calculated by dividing the company's stock price per share by its book value per share. It's a BVPS. So an asset's book value is equal to its carrying value on the balance sheet, and companies calculated netting the asset against its accumulated depreciation. So the book value is also the tangible net asset value of a company, calculated as total assets minus intangible assets. Here I'm talking about everything from patents, goodwill, and the liabilities. So for the initial outlay of an investment, book value may be net or gross of expenses such as trading costs, sales taxes, and service charges. So some people may know this ratio by its less common name, the price equity ratio. So the formula and calculation of PB ratio is on the screen right now. So in this equation, you would see that book value per share is calculated as follows: total assets minus total liabilities divided by number of shares outstanding. So market value per share is obtained by simply looking at the share price quote in the market. So a lower PB ratio could mean the stock is undervalued. However, beware, because this could also mean that something is fundamentally wrong with a company. I will talk about that later on. You have to be very cautious with the financial ratios in general because they vary by industry. So the PB ratio also indicates whether you're paying too much for what would remain if the company went bankrupt immediately. Now that you have a definition of the PB ratio, what can the PB ratio can tell you? What can it tell you about the stock? And I'm first going through the four metrics before we analyze Amazon, because you first need to understand what we're talking about before applying those ratios to the Amazon situation, to the Amazon stock. So PB ratio reflects the value that market participants attach to a company's equity relative to the book value of its equity. So a stock market's value is a forward-looking metric that reflects a company's future cash flows. We all know that, right? So the book value of equity is an accounting measure based on the historic cost principle and reflects past issuances of equity, augmented by any profits or losses, and reduced by dividends and share buybacks. So you have this sort of a dichotomy, if you will, between the past, that's the book value, and the future, that's the market price. So the price to book ratio compares a company's market value to its book value. So the market value of the company is its share price multiplied by the number of outstanding shares. So in other words, if a company liquidated all of its assets and paid off all of its debts, the value remaining will be the company's book value. So PB ratio provides a valuable reality check for investors seeking growth at a reasonable price and is often looked at in conjunction with return on equity, ROE, which is a reliable growth indicator. So if you have large discrepancies, say between on one end the PB ratio and the ROE, this would often send up a red flag on companies. So overvalued growth stocks frequently show a combination of low ROE and high PB ratios. So if a company's return on equity is growing, its price to book ratio should also be growing. So if you see a dichotomy there, then you know there's a red flag. Let's talk about PB ratios and public companies. So it is kind of difficult, folks, to, let's say, to pinpoint a specific numeric value on one end, a good, what I call a good price to book ratio, when determining if a stock is undervalued and therefore a good investment. Ratio analysis, once again, can vary by industry. So a good PB ratio for one industry, say tech, might be a poor ratio for another, say biopharma. So it is helpful to identify some general parameters and metrics on a range for PB value, and then consider various other factors and valuation measures that more accurately interpret the PB value and forecast a company's potential for growth. So here I'm not even talking about the portfolio management metrics such as beta and alpha, but they could help at a later time. So the PB ratio, historically speaking, has been favored by value investors for decades and is widely used by market analysts. So traditionally, any value under 1 is considered a good PB for value investors, indicating a potentially undervalued stock. However, value investors may often consider stocks with a PB value under 3 as their benchmark. So one thing I want to do, I'm showing you right now on the screen here, as you can see, is the PB ratio of Amazon as of October 5th, 2020. And we can see that the PB ratio is 2174. And this graph is courtesy of Macro Trends. So you can see that Amazon PB ratio has been growing from 2007 all the way to 2014. It was kind of flat, and then it started growing around 2015. Right? Okay. So let's talk about the second metric that is important when it comes to evaluating a stock. That's the very popular PE ratio. Everybody knows that, and the price to earning ratio. So this is and this data is publicly available for every stock. You go on financial websites such as MSN Finance, Yahoo Finance, M1, Robinhood, Google Finance. You have the ticker. When you have the ticker symbol, you can have the PE ratio. So the price to earning ratio is the ratio for valuing a company that measures its current share price relative to its share price earnings. Let me repeat that. So you measure the current share price relative to its per share earnings, the EPS. So the price to earnings ratio is also sometimes known as the price multiple or the earnings multiple. So PE ratios are kind of used by investors and analysts to determine the relative value of a company's share in an apple-to-apple comparison. So it can also be used to compare a company against its own historical record or to compare aggregate markets against one another or over time. So you have the analysis, what I call endogenous analysis and exogenous analysis. So endogenous means you're looking at the company itself internally and doing some kind of trend analysis over time. And then you have the exogenous analysis where you basically look at, you basically compare the metrics, the operational metrics of the company versus other rivals, versus its peers. So analysts and investors review a company's PE ratio when they determine, for instance, that the share price accurately represent the projected earnings per share. So I'm showing you right now here on the screen the formula for a PE ratio. So PE ratio equals market value per share divided by EPS, earnings per share. So to determine the PE value, all you got to do is divide the current stock price by the earnings per share. So the current stock price, P, can be gleaned by plugging in a stock ticker symbol in any finance website I already told you, and this concrete value reflects what investors must currently pay for a stock. The EPS is a slightly more nebulous figure. So EPS comes in two main varieties. So the first, it's more an accounting construct. So it is a metric listed in the fundamental section of most finance sites with the notation PE parenthesis TTM. So TTM is the Wall Street acronym for trailing 12 months. So it's retroactive. So this number signals the company's performance over the last 12 months. And the second type of EPS is found in a company's earnings release, which often provides EPS guidance. So this is the company's best educated guess of what it expects to earn in the future. The great thing is that sometimes you have confusion. You do, because sometimes analysts are interested in long-term valuation trends and they consider the PE 10 or PE 30 measures, which averages the past 10 or 30 years of earnings, respectively. So these measures are often used when trying to gauge, for instance, the overall value of a stock index, right? And here we can use the Dow Jones 30 or the S&P 500 because these longer-term measures can compensate for changes in the business cycle. Now, the PE ratio of the S&P 500 has fluctuated so much from a low of around 6 times in 1949 to over 120 times in 2009. Think about that. That's a big delta here. So the long-term average PE for the S&P 500 is around 15 times, meaning the stocks that make up the index collectively command a premium 15 times greater than their weighted average earnings. So here I'm showing you on the screen again the PE ratio, the historical evolution of Amazon PE ratio. This again is a courtesy of MacroTrends. Thank you so much, MacroTrends. And you can see here that the current and historical PE ratio for Amazon from 2006 to 2020. So the price to earnings ratio was calculated in this instance by taking the latest closing price and dividing it by the most recent earnings per share number. So the PE ratio is a simple way to assess whether a stock is over or undervalued and is the most widely used valuation measure. So Amazon PE ratio as of October 5th, 2020 is 123. I'll be right back. Right after this, don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. I hope you are doing fantastic. I'm still going through the main question we're discussing today is whether or not Amazon stock is undervalued, and we're using different metrics to gauge that. But before I get into the nitty-gritty here, I wanted to have a conversation with you around those metrics so you understand what we're talking about, a deep definition. And once you understand, you can even apply those measures to your own portfolio, so you can actually you can scrutinize your portfolio to see if the stocks you're buying or the stock you currently hold are overvalued or undervalued, and whether there is a possibility of portfolio rebalancing here. So I've already spoken to you about the PE and the P and the PB. So price to book and price to earnings. Let's talk about the third category here, the PEG ratio. So this is the PEG ratio or the PEG ratio, the price to earnings growth ratio. What is it exactly? This PEG ratio is the stock's price to earnings, the PE ratio, divided by the growth rate of its earnings for a specific time period. So the PEG ratio is used to determine a stock's value while also factoring into the company's expected earnings growth, and is thought to provide a more complete picture than the more standard PE ratio. A lot of hedge fund managers love this PEG ratio because it gives them an idea not only about the future, about the past, but also the future. So we're putting right now on the screen the PEG ratio, the formula. You can see that it's price divided by EPS, the earnings per share, and then you divide that by the earnings per share's growth. So to calculate the PEG ratio, you need to either look up or calculate the P/E ratio of the company in question. So the P/E ratio is calculated as the price per share of the companies divided by the earnings per share. I already said that. So once you have the PE, you can find the expected growth rate for the stock in question using analyst estimates available on financial websites that follow the stock. And again, you can we have been using Yahoo Finance for the last 3, 4, 5 years, and they're great. So once you have that number, you just want to plug the figures into the equation and solve for the PAG ratio number. And there are some issues when it comes to PAG ratio. I mean, we have a lot of experts have talked about, and we the last time we were here, there was a conversation on CNBC where there was some questions around the accuracy of the PAG ratio. So as with any ratio, folks, the accuracy of the PAG ratio depends on the inputs used. So when considering a company's PAG ratio from a published source, it's important to find out which growth rate was used in the calculation. So Yahoo Finance, for example, calculates PAG using a PE ratio based on current year data and a 5-year expected growth rate, 5 years. So using historical growth rates, for example, may provide an incomplete and inaccurate PAG ratio, especially if future growth rates are expected to deviate from a company's historical growth. So the ratio can be calculated using a 1 year, 3 years, or 5-year expected growth rates, for example. It really depends on the analysis here. So to distinguish between, let's say, calculation methods using future growth and historical growth, the terms forward PAG and trailing PAG are sometimes used. So as we're talking about, we're navigating the retroactive and prospective minefield here, if you will, the forward PAG and the trailing PAG. Let's have a conversation around what the price earnings, the PAG ratio tells you as an investor. So while a low PE ratio may make a stock look like a good buy, a factoring in the company's growth rate to get the stock's PAG ratio may tell a different story. So the lower the PAG ratio, the more, if you really think about it, the more the stock may be undervalued given its future earnings expectations. In other words, it means that investors are not really seeing the juice in the stock yet. So adding a company's expected growth into the ratio helps to adjust the results for companies that may have had a high growth rate and a high PE ratio. So what I'm trying to say here is that the degree to which a PAG ratio result indicates an over or underpriced stock varies by industry, and most importantly, by company type. You can't compare Amazon, for instance, to IBM or to Citibank, for example. So as a broad rule of thumb, some investors feel that a PAG ratio below 1 is desirable. So, and we've had a discussion about this in the team while preparing for this show, and we came across a statement by Peter Lynch. This is a well-known investor, and he says that a company's PE and expected growth should be equal, which denotes a fairly valued company and supports a PAG ratio of 1. So when a company's PAG exceeds 1, it's considered overvalued, while a stock with a PAG of less than 1 is considered undervalued. So we actually have done some research around Amazon PAG ratio, and we're showing this to you right now on the screen. And this is courtesy of Zacks. So thank you very much, Zacks, our friends at Zacks.com. And you can see that currently Amazon.com has a PAG ratio of 4.08 compared to the Internet Commerce Industry's PAG ratio of 3.34. So the company's trailing 12-month, the TTM PAG ratio is the PE ratio divided by the growth rate over the last 12 months. We already said that. So a value greater than 1 in general is not as good. For example, a company with a PE ratio of 25 and a growth rate of 20% will have a PAG ratio of 125. So Zacks.com is just trying to explain here what the result of their what the chart means. But the bottom line here is that you have to be very careful to make sure that the input, the data you're inputting into the formula is accurate. Otherwise, if you put in some bad data, guess what? The formula is going to give you, it's going to spill out a bad result. All right, so this is it. I will be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We're actually having a conversation today around the valuation of Amazon stock. And if you love the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell so that we can inform you in real time whenever we drop a new show. Now, we drop this kind of shows every single day. Every single day, we're not shy. Think about that. Every single day. And if you love the content, please consider subscribing, share this content, like, and most important, comment. Ask questions. Our team reviews all questions, and as long as they are relevant to the subject, we will reply to you. Let's talk about the fourth metric. So I've talked about the PE, the PB ratio, the PAG ratio. Now let's talk about the dividend yield. What is it exactly? The dividend yield expressed as a percentage is a financial ratio, so dividend by price, that shows how much a company pays out in dividends each year relative to its stock price. So the reciprocal of the dividend yield is called the price dividend ratio. So let's try to understand that. What are we talking about here? The dividend yield is an estimate of the dividend-only return of a stock investment. So assuming the dividend is not raised or lowered, the yield will rise when the price of the stock falls. And conversely, it will fall when the price of the stock rises. So because dividends yields change relative to the stock price, it can often look unusually high for stocks that are falling in value quickly. That makes sense because the denominator is being reduced. So new companies that are relatively small but still growing quickly may pay a lower average dividend than mature companies in the same sectors. So in general, though, mature companies, I'm talking about the IBM, the Caterpillar of the world, they are not growing. If they're not growing very quickly, what they do is they pay the highest dividend yields to compensate, right? So consumer non-cyclical stocks that market staple items or utilities are example of entire sectors that pay the highest average yield. Although the dividend yield among technology stocks is lower than average, the same general that applies to mature companies also apply to the technology sector. Let me give you an example. As of May 7, 2020, for example, Qualcomm Incorporated, and this is an established, everybody knows Qualcomm, they're an established telecommunications equipment manufacturer. They had a trailing 12 months a TTM dividends of $2.48. So if you use their current price of 78, 79, 80 bucks, its dividend yield will be around 3.15%. Meanwhile, if you take a company like Square, this is a relatively new mobile payment processor. They pay no dividend at all. So the bottom line here is that in some cases, the dividend yield may not provide that much info about what kind of dividend the company pays, right? So, for example, let me give you a the classic example. The average dividend yield in the market is very high amongst REITs, the real estate investment trust. However, those are the yields from ordinary dividends, which are very different than qualified dividends in that the former is taxed as regular income, while the latter is taxed as capital gains. And so there's a huge difference there. And the thing here is that along with REITs, master limited partnerships, MLPs, and business development companies, the BDCs, they typically have very high dividend yields. So what you have to think about is the legal structure of the company, but also its performance, because the legal structure of the company will affect partially your tax liability. So the structure of these companies is such that the U.S. Treasury requires them to pass on the majority of their income to their shareholders. I'm talking about the MLPs, the BDCs, and the REITs. So this is referred to as a pass-through process, and it means that the company doesn't have to pay income taxes on profits that it distributes as dividends. So, however, the shareholder has to treat the dividend payments as ordinary income and pay taxes on them. So when they file their Form 1040 at the end of the year, they will basically pay taxes on them. Dividends from these types of companies, MLPs and BDCs, do not qualify for capital gains tax treatment. So what I'm trying to say here is that at the end of the year, those MLPs and BDCs, they will file Form 1065 with the IRS, but they're not paying taxes. The Form 1065, it's more what I call FYI only. So they're telling the authorities, hey, listen, this is how much money we made. This is how much money we distributed to our owners. So what the IRS will do is the IRS will compare what the MLP or BDC had sent to it have sent to the agency. They will compare that with what the individual owners are sending to the agency to make sure that everybody is playing game. Nobody's is cheating on their taxes. Now, while the higher tax liability on dividends from ordinary companies lowers the effective yield the investor has earned, even when adjusted for taxes, REITs, MLPs, and BDCs still pay dividends with a higher than average yield, which is why this kind of asset class is very popular with the wealthy. So I'm putting right now on the screen here the formula for dividend yield. It's very simple. Annual dividends per share divided by price per share. Now let's check Amazon dividend yields, and we're using Zacks, and this is very interesting. As you can see on the screen here, there is none. So Amazon.com dividend yield currently sits at 0%, which is in line with the internet commerce industry yield of 0. So the company's TTM dividend yield calculates the indicated annual dividend divided by the stock price. So this value is always expressed as a percentage. So the thing here is that, and this has been subject of many debates, Amazon does not pay dividends, and this is how they want to run the business. And they're thinking that and Jeff Bezos in the past had said, listen, we want to reinvest the funds, we want to reinvest profits into the company to grow the company. And you know what? He's right, because the stock price keeps going up anyway. So shareholders are happy. They are happy. So folks, here's the deal. What are we talking about here? What is the bottom line? I've been talking to you for the last few minutes, 10 minutes, 15 minutes, about 4 different metrics, right? We've been talking about the PE ratios, the PB ratio, the PEG ratio, and the dividend yields. Those are pretty cool. What's the bottom line here? The bottom line is that those 4 ratios are too narrowly focused to stand alone as a single measure of a stock. And by combining these methods of valuation, you can get a better view of a stock's worth. Any of this can be influenced by creative accounting, as can more complex ratios like cash flows. Because if you think about it, the price to book, we're talking about the book value of a stock, the book value of a company rather, and those can be manipulated. We've known, I'm not even want to start a conversation here about Enron and no. So this can actually happen. So what you want to do is you want to add more tools to your valuation methods so that you can spot discrepancies more easily. So these 4 main ratios may be overshadowed by thousands of customized metrics, but they will always be useful stepping stones for finding out whether a stock is worth buying. So what I'm trying to say here is that the financial statements can be used by analysts and investors to compute financial ratios that indicate the health or value of a company and its shares. And the PE, PB, PEG, and dividend ratios, they are wonderful when it comes to evaluating whether a company is worth looking at. So the big question is, folks, is Amazon undervalued? So I have already said that you cannot answer that question by calculating only the PE, the PB, the PEG ratios, as well as the dividend yield, right? So, but by any conventional measure, Amazon, and there are several analysts in the market who are backing me up on this, Amazon seems to be overvalued. So with a market cap of 1.6 trillion as of the date of this show, the show's we are in October 2020, Amazon stock is being valued at over 4 times its potential 2020 revenue of 400 billion. So that's based on its second quarter sales of 101 billion. So it's not unusual to value a tech company at 10 times its sales or even more. But you have to understand, the question is Amazon really a tech company? Based on its business model and based on the vastness, the expensive nature of its business, Amazon isn't really a tech company. They're not. They're more of what I call, and what many investors have called, an infrastructure company. So about 80% of its sales consist of retailing, usually valued at a discount to revenue. So even granting that, Amazon is taking full value from its sales through warehousing and delivery, the famous FBA, the fulfillment by Amazon program. So margins in that sector are kind of slim. just 3.5% in North America for the first half of 2020. So valuing Amazon Web Services at even 20 times sales, or 800 billion, still leaves 850 billion in equity, covering 320 billion in retail revenue. So my point here is that you have bulls and bears, people thinking about whether Amazon should be a hold, should be a sell or a buy. So why the bull on Amazon stock? So despite all the fact I've told you, analysts are pounding the table for Amazon. So right now we have done the math, and we have seen 40 analysts who are following Amazon who have a screaming buy on the stock. So the average 1 year price target is 37.25, which represent a gain of 13% from the average price we have right now of 3,300. So the big second quarters caused 27 analysts to raise the price target by the start of August. So you have to understand that people are fighting for Amazon, and especially because they are saying that you have a huge bump. You've seen a huge bump, around 43% of the company's revenue that now comes from services, including merchants, video, and Prime membership. And which goes back to what I was telling you earlier. Amazon is not really a tech company anymore. So a sum of the parts analysis seriously understates the company's value, according to some analysts. So getting 34% year-over-year sales growth while at a 400 billion a year run rate is impressive. The question is, will that continue? Remember, folks, we are still in the midst of a global pandemic. So will Amazon Web Services finally see Alphabet take away its market share? Alphabet is Google's parent company. So what about Alibaba Group Holding, which is outperforming Amazon in Asia? In other words, Amazon has not been able to penetrate Asia very effectively, and will that come and bite them in the future? So that's really the bull case on Amazon stock. Let's talk now about the bear case. Those analysts who, like us, who believe the company is overvalued at this moment. So getting in front of the Amazon bull is like facing an oncoming freight train. Don't get me wrong on that. I mean, it makes sense. So if you want to talk about Amazon going down, we're not saying Amazon should go down. We're just saying that right now there has to be a new product, new technology, new infrastructure for the company to deserve the valuation it currently has. So Amazon's deep pockets mean its primary video competition is Netflix, where 20 billion in 2019 revenue is worth 217 billion of market cap. But how much of a Prime member's value should be ascribed to the video service, and how much to shipping? That's where the conversation becomes a little complicated. So when you look at Amazon, you have the AWS, the cloud service, you have the entertainment part and the retail part. So how do you actually allocate? How do you allocate where the growth should be in the company? That's what's making a lot of analysts confused about the strategy of Amazon as of right now. So the thing here is that there is an analyst who has said that Amazon bull case is based on the idea that it's worth more together than broken up. But a breakup is what Senator Elizabeth Warren and NYU professor Scott Galloway are calling for. If you remember, less than a year ago, an Atlantic writer who has profiled CEO Jeff Bezos suggested that he might do this voluntarily, spinning off Amazon Web Services. So even without a breakup, regulation is coming, folks. You have to think about that. Regulation always costs the regulated money, because we're thinking about Amazon is getting to the size where it will be a behemoth, and you're going to start having very soon. You're going to have the Department of Justice start thinking about antitrust litigation to sort of break it down, not break it down, but break it apart. So the bottom line is that, as with other cloud stars, Apple, Microsoft, Alphabet, and Facebook, Amazon's current price is built on the COVID-19 market and the Fed. It's not really based on Amazon's performance. I mean, there is just, if you look at it, if you look at the numbers, you do the analysis, there is so much cash floating around, so much ka-ching floating around. So few things are working and stocks are so liquid, it's no surprise cash is floating into these stocks. But liquidity works both ways, right? So each easy money flowing in can quickly become profit taking, a dip, and finally a rout before small investors can respond. So that's what happened in March 2020, March and April. So the pandemic's end will make other things look cheap. So failure to stop the pandemic will make the economic damage too obvious to ignore. And the thing here is that either way, folks, Amazon stock will eventually reflect its fundamental value. And this is the stock that we are really bullish on. It's just that we believe that right now the valuation is not supported by the fundamentals of the company. So the fundamentals are great, but right now those values are stretched. So unless you're looking 10 years from now, 5 years from now, or you are a speculator with the fast sell finger, I wouldn't buy more of it here. So here you have it, folks. Thank you so much for listening to this conversation about whether or not Amazon stock is undervalued. And the thing is, this show was recorded in October 2020. Is recorded in October 2020, but the values that the concept that we discussed are evergreen. They will be still valid 5 years from now, 10 years from now, especially the forward metrics that I told you about. Even though in 20 years and 10 years and 5 years, Amazon's stock price might have tripled or quadrupled or quintupled. But the fundamental metrics of price to book ratio, price to earnings ratio, the PE ratio, the price to earnings growth ratio, the PEG ratio, and the dividend yields, those metrics will stay the same because those are fundamental. Those are part of fundamental analysis. So you can still use them to analyze whether or not a stock you have in your portfolio is overvalued or undervalued. I will see you next time. Until then, remember, stay marvelous.